Hello, my name is Andy Barcade, and I'm the publisher and the editor of the Think to Retire newsletter. Thanks for spending some time with us today to look at our short video, which I've titled Adaptive Investment Allocation, which I'll constantly refer to as AIA throughout our video. So let's go ahead and get started. Okay, the goal of AIA, is with our whole newsletter, Think to Retire, is to help you be more in control of your own money, your own 401ks, your own investments, and do it in such a way to where it takes very little time, simple to use, easy to use, and you can apply it with just a few minutes of your time every month and then stay on top of things. The main goal is to reduce risk. We'll talk a lot about that throughout the video. And we want to be able to reduce risk without giving up all those returns. We believe if you can reduce the downside when the market decides to decline, if you can reduce a lot of that downside, the upside will just be that much greater. We'll show you some examples of that in a few minutes. Also, we're trying to keep the cost extremely affordable so anybody can use this, no matter how much money you've got. And it's going to be a great alternative to paying that fee-based advisor. Again, that's going to charge you more than likely multiple times more than it would be to use our newsletter. And we will argue you'll be safer and your returns will be better using it, the Think to Retire newsletter with AIA involved. Okay. If you're already paying an advisor, maybe you're thinking about it. Maybe you think you need to, or you have to, or you're continuing to use an advisor because it's just too complicated to do yourself. It's too time consuming. You don't have the wherewithal to continue to do this. Well, we think you're wrong. We think you can do it by yourself with just a little bit of help. And we think AIA and our newsletter, Think to Retire, can be that help to help you constantly stay on top of your own affairs and have better results and save yourself a whole lot of money at the same time. Okay. I've always believed, and there's a lot of data to back it, and part of our premise here is individual investors tend to either fail or underperform, not because you're not smart enough, not because you don't care enough. That's absolutely not true. Most people tend to not do as well or underperform, mainly because they don't have a system to help them. They don't have a methodology that they're relying on to lead them to do what they're doing and why they're doing and when they're doing it, and hopefully keep you out of trouble and make decisions that are based on fact, not emotion, and not just all the smoke that's out there and all the noise that's out there in the economy and the investing world. We like to say that we're making our decisions. We're giving you our suggested allocations based upon math, based upon data, not emotion. Okay. A lot of you may not recognize this person. He is one of the godfathers of investment analysis. His name is Benjamin Graham, and he was a professor at Princeton. Now, one of his most favorite or most famous clients, I should say, or students, was Warren Buffett. So he's been around a long time, and he said a lot of things that are very quote-worthy, but this is one of the biggest ones he said, and it kind of defines the essence of our whole newsletter. The essence of investment management is the management of risk, not the management of return. And again, we believe if you can control risk, take a lot of the downside out of it, the upside is just that much easier to attain. Okay. This is a little bit about investors and their returns versus the market returns over the long run. And this graph was put out by Dalbar. They do a study every year, and it does a lot of things. But one of the things it does, it measures the return of the market and the return of the investor who is investing in the market. So again, it's kind of a grade of how investors do based upon the market. And just to give you a clue, investors tend to always underperform the market for a lot of reasons. And one of them is just their decision-making matrix that they have, how they're doing, what they're doing, and why they're doing it. In a lot of cases, too much based upon emotion. But if you just go out and look at the 30-year number out here, the average investor over that 30-year period has made about 4% a year. The market is made about a little over 10%. So why such a big difference? In most cases, investors are making decisions more on emotional reasons versus data and metrics and actually fact. So that's what we're trying to add that as one of the decision-making ideas that you as an individual investor can have to make better decisions over the long run. Okay. We believe also what's going to happen in the market, what's going to happen in the economy, a year from now, 2 years from now, 3 years from now is always something to think about, but it's not that important about how your money needs to be allocated today. We want to look at the data. We want to look at the metrics of what's going in the market right now. We're focused on what's happening right in front of us and making decisions based upon that. Now, this artwork you see here is kind of a depiction of that. If you're driving to your destination. Say it's at night. Well, do you need to be able to see all the way to your destination? Of course not. You need to see what's happening right in front of you. If you can constantly see what's right in front of you, maybe 200 or 300 yards right in front of you, you can actually get to your destination safely. And if trouble appears right in front of you, you'll have time to make some maneuvers to avoid getting in trouble. And AI is trying to do the same thing. We're trying to look at the data in the market and judge, is the market direction, which is currently going on, what's the probability of that continuing? If the market is in an uptrend, we're looking at the data, looking at the metrics, and trying to figure out what the probability is that that direction, that upward movement is going to continue. And the same for the downside. If the market is falling, we're looking at all the data around the market consistently every day and trying to judge, is that downtrend going to continue? Okay. Also, what's happening is there's sectors, there's asset classes in the market, and we're ranking them as to their strength. Markets tend to have personalities. That's a funny way of saying what the market likes today, it may not like tomorrow. Based upon what's happening in the world, based upon what's going on in the economy, certain sectors, certain asset classes are stronger and certain ones are weaker. And there's a rotation there. Technology may be stronger today. A few months down the road, it may be energy, it may be communication. Large cap may be strong today, small cap may be stronger a couple months from now. That current rotation is being looked at and ranked, and we're taking that data, overlaying it on your 401ks, the mutual funds that you have in your 401k or your 403b, your mutual fund family you might be using, or maybe even in the investment platform you have at your brokerage firm, you're probably using exchange traded funds. We're overlaying that data on the stronger sectors and asset classes and giving you the list of the ones that are performing the best at the time. And again, that's changing every month as we send out the newsletter. So there may be no changes from month to month, but again, there may be several changes based on what the market's doing. So we're constantly trying to keep you in the stronger areas as time goes on. And again, if the market's in an uptrend, you want to be in the stronger areas. If the market's in a downtrend, we want to be out of the market altogether. We're going to talk about that in our risk indicators in just a second. Okay. This is a partial copy of our newsletter that comes out every month. There's quite a bit of narrative that goes along with this, talking about the market, what's happening, why we're doing what we're doing, why we're suggesting what we're suggesting. But these are the actual allocations given to a subscriber. Now, this is a couple years old, so these are all out of date. But this individual person was using 3 different accounts with AIA and with Think to Retire. Now, it's important to understand there's only one price. There's a family price. The entire family, husband, wife, couple, they can use this AIA on as many accounts as they want, and they're just using them for 3. They've got a Schwab brokerage account where they're using ETFs. One of them works at the county with a 457. The other one works at a corporation with a 401k. One price, you can use on as many accounts as you like. This is an example of some of the allocations that have been suggested from the stronger sectors at that particular time. And it's important to understand a month later, this is going to have changed a little bit. You simply have to just be able to open your emails, be able to log in your brokerage accounts, your 401ks, your 457s, and make those changes. And again, once you've done it a couple of times, it'll probably take you 10 minutes to make the changes, and you can go about your life and you'll get another newsletter on the first business day of the next month. Okay, let's talk about risk indicators for just a minute. We are very, as we mentioned earlier, concerned about risk and controlling it. The risk indicators are some of the biggest reasons and the biggest ways we're doing that. We have 2 risk indicators we're using. We call them T2R 1.0 and 2.0, Think to Retire 1 and 2. 1 is a more longer term indicator of market direction. 2 is a bit shorter term. What's important to understand is these have to both be positive for us to suggest being more in the market. If either one of them turn negative, we're going to send you an allocation alert and suggest you move back to safer areas. And we'll tell you the areas to be in. The different, maybe mutual funds could be bonds, money markets, cash accounts. We'll suggest that you we'll suggest you go back into those, and they'll be also tied directly to your 401k, your brokerage account, or your 457 you're using. So you'll know exactly which funds to get into and get out of, depending on which way these indicators are going. Okay. As I mentioned before, the newsletter comes out the first business day of every month. There will be alerts, like I just mentioned. If one of those risk indicators trigger, you'll get an alert to either suggest you move away from the market, and we'll tell you the funds to move out of and move into. Or the other way direct. If you're out of the market, we may get an alert to get back in the market. And again, we'll give you the actual funds to actually move back into. And we want to make this thing to where it's very simple to use. We don't want to send you emails every day. Do we have to constantly look at things and stay up on things? We want to send you something once a month to give you ideas what to do, and hopefully have it maybe take 10 or 15 minutes to apply, and you can go back to the rest of your life. Okay. Here's some ideas on some of the things or some of the returns that AIA has exhibited over the last umpteen years. This is, if you see on the top, AIA moderate growth. Now that is basically a 60-40 split. 60% of the money is being used with AIA and the allocations we would suggest, and the other 40% is in something safer, bonds, money markets, CDs, fixed annuities, something like that, but safer. It's not in the market. These are the returns going back roughly 20 years, from 2001 to the end of 2020, it looks like. As you can see, the gray line is the stock market, the S&P 500. The blue line is AIA moderate. And you can see, obviously, the line is higher. But what I wanted to point out to you is by reducing volatility, that's what got this line to outperform. Now, it's kind of hard to see, but you see that dip right there? That is the turn of the century. That is the dot-com bust. That's 9/11. Y2K, all that was mixed in there. That was over a 40% drop in the S&P during that period of time. AIA, by and large, avoided most of that. The other drop here, you see right around here, that's about 2007 and 8. That was the mortgage meltdown. The S&P was down over 50% during that period of time. AIA, again, got out and avoided most of that downside. Again, this is not a perfect system. It's not designed to try to get rich quick. It's designed to make you better at avoiding risk and hence have better returns over the long run. And over here, we see that's COVID. That's about a 30% drop. Lucky enough, we got out and backed out of the market during the first week or two of COVID and avoided a lot of the downside there. Now, just also important to look at the maximum drawdown, which is defined as the biggest dip that AIA took over that 20-year period, was just shy of 10%, 9.9. The biggest drop the S&P had was 55, and that was in this big period of the mortgage meltdown a few years ago. And it's also important to look at the returns. The average return of the S&P over that 20-year period was about 7%. The average return for AIA moderate was over 12, quite a bit different. And again, the bigger returns came not by just magic. That's not it at all. It's more about just trying to avoid the downside and take a lot of the loss out of the situation. Okay, this next slide is AIA growth. Let me get it to turn here. Oh, there we go, AIA growth. This is about 80% using AIA and only 20% in something safer like bonds, money markets, fixed annuities, something like that, but not in the market. And you can see the returns are just a little bit bigger, the same roughly 7% for the S&P, but a little over 14 over the long run. The volatility was a bit more. Instead of about 9.9, it's a little over 12. But again, a whole lot less volatile than the market. Okay. What you get with the Think to Retire newsletter, we mentioned this in most of our videos. You're going to get a monthly newsletter. It's going to keep you current. It's going to tell you the allocation suggestions for your specific 401k, 403b, mutual fund families, or the brokerage platform you're using where you may be trading exchange-traded funds. We're also going to send you out alerts when the risk indicators trigger, either to get out of the market or to get back in. We have weekly market updates, which you're going to drop in your inbox every Monday morning, just kind of giving you a wrap-up of what happened last week and why. And then again, what may be happening in store for us. Just something that'll take you 5 minutes to read and just kind of keep you up to date. Another important thing we do is we have monthly webinars. They're live. You'll get invitations to them. You can sign up for them, and they're designed to just kind of go through methodology, talk a little bit about the newsletter. We want to make sure you know the best way to use them so you can get the best outcomes for you and in your situation, however you want to use the AIA process. And again, visit our library, visit our video library where this video will be and other videos will be, so you can actually learn a little bit more about how the newsletter is meant to function and a lot more about AIA. And always, oh, here we go. And always go to the website. On most of our emails, there'll be a link where you can actually request a phone call, to request a demo, to just explain things, to help coach you so you understand how to use our system that much better. And if those of you out there listening are actually current members, by all means, we probably already talked to you multiple times. Again, if you ever have any questions, just do the same thing, request a demo, request a phone call. We'll get on the line with you. You may even be talking to me, and we just want to make sure you understand how to use this system best. If you haven't used it before, if you're just kind of kicking the tires, just go ahead and request a demo. We'll be happy to run you through the paces, give you an idea how you can use it in your circumstances, and you can actually figure out how Think to Retire and AIA can benefit you the best. So until then, thank you for your time. My name again is Andy Barcade. I am the publisher and the editor of the Think to Retire newsletter. Enjoy the rest of your day.